Now we'll see the various participants in commodity market. An efficient market for commodity futures requires a large number of market participants who have diverse risk profiles. Market participants can be broadly divided into three: hedgers, speculators, and arbitrators. We'll now see each one of them briefly. Hedgers. Hedgers are generally the commercial producers and consumers of the traded commodities. They participate in the market to manage their spot market price risk. Commodity prices are volatile, that we have already seen, and their participation of the hedgers in the future market allows them to hedge or protect themselves against the risk of losses from fluctuating prices. For example, a copper smelter will hedge by selling copper futures since it is exposed to the risk of falling copper prices. Next are the speculators. Speculators are the traders who speculate on the direction of the futures prices with the intention of making money. Thus, for the speculators, trading in commodity futures is an investment option. Most speculators do not prefer to make or accept deliveries of the actual commodities. Rather, they liquidate their positions before the expiry date of the contract. Last are the arbitrators. They are the traders who buy and sell to make money on the price differentials prevalent across different markets. Arbitrage involves simultaneous sale and purchase of the same commodity but in different markets. Arbitrage keeps the prices in different markets in line with each other. Usually such transactions are risk-free. Now you must be wondering how this whole future commodity market actually works. Everything looks very complex right now. With the help of this example, let's understand how commodity market works and why people engage in such contracts. The person you are seeing here is a corn farmer who wants to protect himself from possible future declining prices and a potential loss at the harvest time. This farmer has incurred some cost into planting, growing, and harvesting his corn crop. He wants to get his cost back plus hopefully a profit on it. But this crop won't be ready to harvest and sell for the next 6 months. On top of it, all sort of factors like the weather, temperature, rain, drought could impact his corn crop, and the final price that he might get for his crop would be really less if he sold it 6 months later. So what does he do now? Here future comes to his help. He agrees to sell his corn in the futures market to a commercial producer today for a set specified price for delivery 6 months later. Now the same scenario works for this person who is a corn cereal producer, and he wants to lock in the lowest price for the raw corn which he requires. The corn which he requires is this from the futures market, which will be processed in his factory to make corn cereals. Just in case the farmer is a crop shortage resulting in high demand and rising prices at the harvest. The cereal maker wants to avoid this situation, so he agrees to buy the corn he needs in the commodity markets and locks in a price months earlier at planting for delivery after 6 months. The bottom line of this story is both the commercial parties, the farmer and the cereal producer, got what they wanted out of the trade. They are both more concerned with minimizing their future risk than maximizing their profit. The farmer protected himself from possible future declining prices and a potential loss, and the cereal maker protected himself from possible future rising commodity prices and potential lower profit. So here both the parties are now happy because of the futures contract.